Good morning, ladies and gentlemen. I'm sorry we've got to go to the lower resolution software because the other one failed me today. It's driven me nuts. But as you can see, we improved the score to 44, which is not a big deal. I've looked at all the spreads again, and it's not a particularly bullish picture. But what that tells me is that the market is caught short equities and is basically reallocating away from bonds into equities, probably doing it at exactly the wrong level. This has, a lot more room to push up, so we will probably be in risk on for several more months, I would say, probably until the middle of next year. That's my guess. Before we can, establish a proper trend. And now, I think deviations is going to tell its own story, and I think the charts themselves are going to tell their own story here. It's a story of low volatility. It's a story of continued risk on for the foreseeable future, but with some very nasty drops in between, simply because the market is priced very high and priced for disappointment. Well, deviations does tell the story, doesn't it? I can't help draw a parallel with this period here. When basically people had to buy every dip. And really, that is that. The hedge funds and a lot of the investing community are caught under allocated. I think that is as simple as you can put it. Every time you saw on Friday, every time the market goes quiet and there's nothing happening, equities drift up and bonds drift down, real money being put to work. Does that mean that we are in for a spike? I don't think so. I think the downside is far more likely at some stage. We're bound to get some disappointing numbers at some stage or news, and then you get this. You get the move straight back down towards the middle of the 50 SMA, and that, by that time probably will be at 3,000. So I think the market is now caught between a 3,000, 3,120 range. But, it doesn't pay to get short too early. If you look at all the individual sectors, you will see how overbought the important ones are and how basically cheap now are the ones that everybody loved during the best part of the past 6 months, when everybody loved bonds and thought bonds were the greatest thing on earth, and buy bonds wear diamonds and all that bullshit. So now they're in the green, and this to me tells me that it's time to start leaning against this hugely bullish narrative that is out there. And the major sectors, XL, this is not a major sector naturally, XLB, but the major sectors like XLK just will not, it's primed for disappointment. Okay, it's just absolutely primed for disappointment. And even XLF, which has been really doing so well on the back of the bonds, is also primed for disappointment. So you really should reallocate away, certainly from XLV, which to me is an accident waiting to happen at any stage, towards the markets, the parts of the market which are not expensive, but which are in a bullish overall positions like XLY. The consumer is in an excellent state. If we are not to get a recession over the course of next year, and I don't think we will, with all the data that we're seeing, XLY could be a hidden gem and something to buy on all dips. I think really you're getting the picture, a very clear picture from the Blue Angels. The Blue Angels are basically keeling over. I'm not saying they will keel over. I'm saying they will remain relatively flat. And where are we? We're times 17 and a half. People are reaching. People are really, really reaching here. And you know, the upside to me is very limited. The way I keep on trading, I keep on buying the silly dip, and I keep on, you know, taking profit because I'm not going to get to be caught getting you know, too long of equities at these levels. I just don't see the point. I know that at some stage there will be a dip down to that 17 level. What's that? Just over 3,000, 3,025. We will see 3,025 again. I'm absolutely positive of that. Now, can we slowly then grind up together with a move in the Blue Angels? Yes, but I'm in no hurry to participate here. A review of the bond markets actually gives you a very good idea where we are at the moment. Okay, this is the 2-year. This area here, if seen, is going to be such a wonderful area, 177 to 185. Okay, I don't think we might see the bottom of it, but this is the area where I get very long of 2-year notes, and it makes sense from a technical point of view, but more importantly, it makes sense from a pure yield point of view. At some stage that will start becoming a very nice positive carry play, and the futures will stop decaying the position. So really that is a wonderful place to get long of 2 years. I just want to go and show you the 5 years in Germany. This is the area where I think it's going to be very exciting to see what happens to them. 0.48 to 0.41, so that's a 7 basis points. 0.48 to 0.41, I don't think we get through there in a hurry. Okay, I really don't. That represents huge value to me. In the 10-year, in the bonds, which I basically got slightly wrong because I thought that this would be the top. Here we are, we have the 0.382 retracement at, you know, roughly 15 basis points. So that's another, what, 10 basis points from what we got on Friday. But we are, as you can see, we are getting to the last bit of the fumes of what is likely to be the backup in yields. If you have a look at the US 10-year against the German 10-year, 210, it just can't get through that level 210. Okay, so it's in a wonderful stable pattern. That tells me that there is absolutely no reason now to think that this will move wildly before year end. But the one that is very interesting in terms of risk reward is the Italy 10-year versus the Germany 10-year. That one is, in a terms of risk reward, is really wonderful. I had prepared this chart, but for some reason it unprepared itself. I have no idea why it's doing this. Just a second, let's see if it, no, well, that's what it is. Now, this level here, 135, is a wonderful level. So basically, if you get long of Germany and short of Italy, you want to be doing it even at these levels, okay, minus 154, but you use this as your stop. Minus 136. 136 is a wonderful level to use as a stop because you know below there you are wrong. So you have a very good risk reward here of being long of bunds and short of Italy. I think that's a trade which should work for, I don't know, back up to into the 180s. So really you have a 30-point upside towards a 15-point downside. So not a bad risk reward. So that's the one I like. And the 5-year US is actually, behaving exactly as I thought it would. It's repeating this pattern. Okay, so you know that at this very important 1.77 level, it just backs off. The worst you're going to see is 1.87. So every time you trade at 177, you know that the risk reward is in your favor. So if next week it starts pushing up there, you will know, and you look at the Bollinger Bands, 194, it'll come in. You know that you have a wonderful risk reward play to be long of 5 years. Long of 2 years and 5 years is going to be a wonderful low risk, high reward play from these yield levels. That's and that really is coming together with what I showed you earlier in terms of deviations, in terms of equities just being overvalued at these levels, and people just reaching for equities because they have to, because it's coming towards year end. But to me, it's, at these levels, it's time to start reaching against it, just slowly pushing against it. It makes more sense to be long of 2s and 5s than to be long of equities now. But I also wanted to show you TLT. Okay, I would not touch TLT from the long side until we get to at least 132.08. Okay, that is the level that I mean, above it, I just don't want to know about it. But really, the level I would buy TLT would be here at this 127.5-ish level. That is a decent risk reward. So what I'm showing you is that 2s and 5s are getting to levels that are very interesting, but the long end really isn't as yet. The long end could have quite a bit more to go, and I think next week they will hit the long end at some stage again. So that is why I'm uncomfortable buying the TLT. Technically, it's not in a very interesting place. Technically, the yield curve is not a very interesting place, and therefore 2s and 5s all day. I think the risk there is going to be very low at the levels I've shown you. Well, the dollar's been very hard and unkind to me this year. I really don't know what to say. I just thought there would be acceleration below 110.08. There really wasn't. I got excited down here. I thought we would get down to 107, straight back to the 200-day moving average, and straight back down. This is a sign of a market which basically, doesn't know what to do. And I'm refusing to play until I see some clarity. I do not see any clarity in the dollar, neither in the yield differentials, which I showed you earlier in the Bund against the 10-year spread. I see no trend there. I see in a tight range, and I do not see any evidence that anything is changing in any way. Therefore, the dollar should be strong and should maintain strong. But what I really would like to see is a change in emphasis of policy from Lagarde at the ECB, which would allow the euro to appreciate substantially. And that will be so clear because she will come out with a speech and say, I'm in favor of this, and that is a strong euro policy or whatever, or she won't. So I think that is why the market is now cautious, because it's waiting for some statement from her. If we look at DXY, same picture really. I mean, it cannot break and stay below or turn the 200-day moving average. On the other hand, it is caught by the Bollinger Bands because it can never remain. What the market needs to do here is remain at the higher levels of the Bollinger Bands and push them, and it just never does that. So to me, probably we will end up the week somewhere around 98, which is neither bullish nor bearish, but the picture gets increasingly bearish as we cannot accelerate higher. So it we are basically flattening the 200-day moving average, and at some stage we break below. And that's going to be the interesting play, because at the moment I just can't see the acceleration above. Well, gold, what a beautiful market. 1757 to the tick, and then the $10 bounce on Friday. This is a weekly chart, so you don't see it. But I think it's because I don't see that TLT and the long end have really stopped going down. I think there'll be one more sell-off in gold at some stage over the course of the next couple of weeks, when they slam it back down to sort of this kind of level, and this is the 1400 1410 level. That will be a decent buy, I think, because the odds of a substantial rally for 1410 are very good, technically speaking. And I showed you that I think that is where TLT and the long end stops. And as soon as that stops, gold will be in demand again. So around the 1410 area, 1415 is a decent medium-term buy for gold, and certainly something that I'm looking to do myself. So where are we in equities? From a monthly chart, there's nothing wrong with this. As long as it stays above 2940 to this 2990 area, you can go and test it, but as long as it keeps on closing above it, it's opening up the Bollingers, and slowly we are in for this kind of stuff. But it's going to take a long time to turn the blue angels, and therefore I think the market is trapped. 3120 is as good as it's going to get over the course of the next month or so. If we look at the weeklies, we are right on top of the Bollinger Bands, and really we are on fumes up here. Much more likely to have a dip down towards 3000, fill all sorts of daily gaps. If we look at the daily, you will see how many gaps we have all the way down to 29.55. It would be nice, it would certainly, I think, any dip 30.20s is going to catch it. That kind of stuff, that's the first level that you want to be buying. We are overbought, but this is what people are doing. People are based here, and I'll enlarge it for you. Every time we drop 10 ticks, people are buying because they need it. You can see how well it's holding these moving averages. But I don't think it'll last forever, simply because I showed you the blue angels, I showed you the deviations. It's unlikely to happen. We are much more likely over the course of the next couple of weeks at some stage to come down to at least 30.60, if not down to these kind of levels, the 29.28. 30.28, completely normal. Nothing really that should worry you. We will still be in complete risk on. It's a low volatility environment. If people start now bidding up volatility because the market is down 1.5% off the highs, well, they're just plain stupid and they deserve to get slaughtered. I am a seller of volatility on all run-ups, simply because I don't see what there is to fear. And this is VIX. You can see how it's been trapped in such a small range. If we enlarge this daily range down here, what can you say about this? What I can say is that people are using this as a bottom in VIX, and buying options. But to me, look, realized, the current volatility of the market, the day-to-day volatility that you see is around 5%. Slowly, people are going to start realizing that buying volatility at 12%, when what you are actually seeing realized in the market is 4-5%. Last week we traded in a 1% range. That is not the stuff that volatility spikes are made of. Now, can volatility get get up to 14, 14 and a half to around these moving averages? Of course it can, because people can get squeezed, people can get panicked, all kinds of stupid things can happen. But that is the spike that you sell. That is what I'm saying. The market is going to trade in a 3% range. Probably we are towards within a percent of a very good medium-term high. And then it backs off towards the 30-30 area, 30-25. But that is still, what is it, a 2.5-3% range. And if volatility does this towards the 14.5, that is absolutely wonderful. What a beautiful level to sell. Plus the curve is so steep. The curve is so steep that really you're going to get hurt very little in volatility by carrying the front month contract through, because the front month contract is already trading up here. Okay, so even the spike is going to make you lose very, very little money. So your risk reward of being short the front months of the curve in volatility is almost non-existent, unless we get a really substantial spike, and I really don't see what's going to cause that at the moment. Certainly Europe is being outperforming the States over the past month or so, but I think that outperformance is beginning to come to an end. This kind of level in the DAX is going to be very interesting for some put spreads. 13,550 to 13,600. I would love the market to just bust it by a few ticks and take out the stops and then come straight back down towards the 12,400 level. But that is where I'll be interested in getting some put spreads on board. As I said, 12,500 to 12,600. That is the area that you are interested in some put spreads for a move back down. I'm still bullish of this longer term. I'm still bullish of it. I don't see I don't see the stocks giving up until we at least touch this line. Let me enlarge this so you can see it works very well, and this line, I think, on the enlargement here is going to be somewhere here, 3,830. So still I think the stocks probably do well over the course of the next couple of weeks, but then then that's it. I don't see them. I see a retracement from those levels all the way back down towards even 3,400, 3,500, something like that. So it's it's still risk on. There's absolutely no question of that. Still, for the next week or two, maybe the Europeans outperform the States, but it's coming to an end. And here, my friend, the Nikkei, which I continue to love. I kept on telling you 23,005. We just bust straight through there, and now it's support. You can see this is a weekly chart, and you can see how we are trading above the weekly Bollinger Band, but we are basically in, this is the trend. This is the trend channel, and we've held it all year. We've held it for best part of 2 years now, the trend channel. So really we're here at the beginning of 18 and we're here at the end of 19. So basically for 2 years the Nikkei has done nothing. That's undervalued probably. You have a Bank of Japan which is very, very accommodative, and they're buying equities, and really, with this kind of if you look where all the moving averages on the weeklies are concentrated, you have fantastic support between 20,000 and 21,600. So all these dips down below 23,005 are going to be, in my mind, opportunities to get long again. This is still my favorite market to position in. Simply because I think nobody else owns it. Well, finally to the biases. I've put all the levels here. I still think that 2 years is going to find it very hard to break through 169. But if we do see 177 to 185, I think it's time to bet the ranch there, because you even get positive carry on the futures. It's going to be a wonderful position to have. So let's hope so. 5 years, that 177 level, you saw on the chart how you can get spikes up to 187, but they're quickly reversed. Again, that is going to be a very, very interesting level to get long of fives. Now, bubble, I showed you where my interest was, around the 48 to 41 area minus, and the Bund, now think that the longer ends are all getting hit, aren't they? At some stage it probably gets hit to minus 14, but that is going to be an excellent risk reward going into ECB QE for the foreseeable future. What is going to be very interesting is that at some stage Lagarde is going to come out with a statement speech, her statement speech, that is going to differentiate her from Draghi. And that is really what you have to wait for, to absolutely load up. Because when she gives you that direction, just like Draghi did, 8 years ago, whenever it was, that sets the tone for the next, decade. And that is going to be very exciting, and that is what I'm looking for before I get, overly positioned in anything. I like the short Italy long bunds with the leaning against the 136 level every time it dips into the 140s. Interesting trade to put on because you have such a good risk reward around 136. If things start really getting bad, this could go to 200, 220 in no time at all. Now, I haven't changed my mind about equities. Nothing really has happened there to change my mind. 3025, 3115 is your range. We're very close to it. We're less than 1% away from the top. I see no point in playing that as opposed to riding the curve in volatility. So I'd much rather be short of volatility than long of the market. And European equities, 13,500 to 13,600 is your interesting level for risk reversal options. This might actually coincide with these levels in bunds and bubbles, and then that would really get me excited. In the dollar, I've told you, no idea. I'm going to basically play it by ear and actually wait for Lagarde to tell me what's going to go on for the foreseeable future. The Draghi era is at an end. Let's get some fundamental steers as opposed to constantly chasing the market. Thank you very much indeed, and speak to you on Monday.